Before we start the video, I'd just like to introduce our new revision package. For $10, you get 7 days access to our entire ACCA Performance Management exam course. For more details, please check out the links in the description below. And now, on to our video. Hello everyone, and today we're going to be doing yet another past paper question for the ACCA Performance Management exam. This time we're doing a question from June 2018, question number 32 from section C, about the Alka hotel. And this question, the topic is basically CVP, or cost volume profit analysis, which is not tested that frequently in section C, but as some of the other topics like variances or analysis or transfer pricing, but it's there. It sometimes does appear. So I thought it would be a good question for us to try. So as always, we're going to start with the requirements. So for this particular question, we have 4 requirements, and they're broken up into 4 marks for the first 3 and then 8 marks for the final one, for 20 marks in total. 20-marker question, 1.8 minutes per mark, approximately 36 minutes per section C question in the exam. But that being said, students usually take less than the allocated time for the multiple choice, so they have more time to spend in section C. So you should aim for around 40 minutes, 45 minutes max for completing one of these questions, okay? Now, let's start with the first requirement, part A. Using the current annual budgeted figures and ignoring the 2 proposed projects, okay? So we have nothing to do with the projects right now. Calculate the break-even number of occupied room nights. So break-even number of units, basically. What was the formula? Fixed cost over contribution per unit, in this case contribution per room night, and the margin of safety as a percentage. Margin of safety, what was the formula? Budgeted sales minus break-even sales over budgeted sales. Okay, so let's start with the question. This is for 4 marks. So let's start by labeling our question 32, part A. As always, let's make the labels bold to distinguish them from the rest of the answer. So let's start by reading. So it's saying ignore the 2 projects. So we can ignore all of this stuff then, and the graph. Okay. So the Alka hotel is situated in a major city close to many theaters and restaurants. The Alka hotel has 25 double bedrooms and it charges guests $180 per room per night. So per room night, the revenue is $180. Regardless of single or double occupancy, the hotel's variable cost is $60 per occupied room per night, right? So we can already find our contribution. So contribution per room night is, we'll just extend this, the 180 minus 60, and that's what I usually recommend. Now that we've gone through the requirement, while going through the question, we can pick up the information we want and do the calculation side by side, right? Rather than going through the whole question, then the requirement, then going back through the whole question, right? Much more efficient. Okay. The Alka hotel is open for 365 days a year and has 70% budgeted occupancy rate. So that's for the budgeted number of rooms that we can have. Okay, but first let's just finish this calculation. We just need the fixed cost, and that's coming up. Fixed costs are budgeted at $600,000 a year and accrue evenly throughout the year. Okay, during the it's mentioning the first quarter and it's mentioning the year. So we need to be careful, right? Read every word. Here it's saying fixed costs accrue throughout the year. So the 600,000 is an annual figure, but then they're talking about quarter 1. Let's just revisit our requirement to make sure if they're asking for a yearly amount or a quarterly amount. So it says using the annual budgeted figure. So we need to do it on a yearly basis. So we won't divide the fixed cost by 4. We'll keep them at 600,000. So fixed cost are 600,000. We'll just put them in a cell here so that we don't have to type them every time they come up in a calculation, right? So that means break even number of room nights is simply the fixed cost over the 120 in this case, which is 5,000. Okay, so first part done. Second part, we need the margin of safety, for which we need the budgeted room nights. So we have the break even. Let's find the budgeted room nights. Budgeted room nights. So we have the information here. It's 70% occupancy rate, 365 days a year, and we're looking at things annually, and they have 25 bedrooms, right? So this is going to be 25 bedrooms into 365 days into a 70% occupancy, right? So 6,387.5. Okay, so our margin of safety, and this is a percentage, so let's specify that, is the budgeted rooms minus the break-even rooms over the budgeted rooms. Please be careful about that, right? So again, this should be in a percentage. Let's change the format. So it's approximately 21.72%. And we're done with part A of the requirement for 4 marks. Okay, simple, smooth, and efficient. Now, let's look at part B. Ignoring the 2 proposed projects, so we still ignore them, calculate the budgeted profit or loss for quarter 1. So this is a tip I need to give you guys. Please read the requirements very carefully, right? I know it's difficult sometimes in the exam, you're in a hurry and you skip over things. But because we're reading them word by word, we're able to distinguish the fact that this was annual, this was quarterly. Because this will impact our calculation. Some numbers we might have to divide by 4 or something, right? So please be careful. This is a very common mistake that students make in the exam, mixing up these things. And explain whether the hotel should close for the duration of quarter 1. So we need to make a decision. We need to explain whether the hotel should close for quarter 1 based on the budgeted profit or loss. Okay. So we're still ignoring the projects, but I think this information is going to be relevant now. Okay, during the first quarter of the year, the room occupancy rates are significantly below the levels expected at other times of the year with Alka Hotel, expecting to sell 900 occupied rooms in quarter 1. Okay, so only 900 rooms. Options to improve profitability are being considered, including closing the hotel for the duration of quarter 1 or adopting one of 2 possible projects. So the projects aren't relevant, and that's what they're asking. Should they close the hotel for quarter 1? So profit. There's 900 rooms available, so technically we can calculate the contribution directly, or we can do it separately. I would do it separately just because it's more presentable, but you can do it collectively. You won't lose any marks. Okay, so the revenue, so this is for quarter 1. Okay, so let's just label that up here so that's clear that this is for quarter 1. Revenue is going to be, so there's 900 rooms into the 180 per room night. Okay, the variable costs are going to be 900 into the minus $60, which we've seen, right? Again, you could have simply done 900 into 180 minus 60 to get the contribution directly. You would not lose any marks, up to you, right? So let's make this bold. And then we have the fixed cost, but now we need to be careful. The fixed cost we have over here is annual. We need it quarterly. So we need to divide this by 4. Okay, and let's just make it clear over here as well so the marker can follow as well. These are annual fixed cost. Okay, that means our profit is going to be, it's actually a loss of 42,000. Okay. So the decision, should they close for quarter 1? Now immediately looking at the profit or loss, you'll say, yeah, they're making a huge loss, close for quarter 1. But let's consider other things as well, right? Because they want us to explain. From a relevant costing perspective, we're doing performance management, we need to gear ourselves so that we don't always think of things in terms of normal accounting profit and loss, right? What's going to happen? We have fixed costs. Are fixed costs relevant? No, they're still going to incur the 150,000 fixed cost whether the hotel closes or remains open, right? Regardless of the rooms they rent out. So if we close down the hotel, we lose the revenue and variable costs. Those are relevant. We lose the contribution of 108,000, but we still incur the fixed cost. So technically our loss will be even bigger. It will be the fixed cost minus 150,000 if we close the hotel. Furthermore, just think about it from a non-financial standpoint. If you close a hotel for a quarter, what's going to happen? You can potentially lose some of your customers, right? If they don't find that you're available, they'll go to your competitors and they might stay with your competitors. So there's that as well, right? So let's just explain what we have, because they've asked us for an explanation as well. So the hotel makes a loss of minus 42,000 during Q1. Let's just move this up a bit. While this is bad, we need to consider the fact that fixed cost will be incurred regardless of whether the hotel remains open or closed. If we close the hotel, then the contribution of 108,000 will be lost, and the loss will actually increase to minus $150,000, right? Furthermore, being closed for an entire quarter can result in losing customers to competitors, not just customers, right? It could also mean, because hotels have a lot of temporary staff, so you could lose them too, right? Because they'll say that this hotel, we can't always rely on them for employment. It will also mean losing out on employees such as temporary staff. Given all of this, it is advisable to keep the hotel open during Q1. Okay, and we'll just make this bold because this is our conclusion. Okay, so part B for 4 marks, and we're done. Let's continue on to part C, again for 4 marks. So now we're dealing with the project. Calculate the break-even point in sales value. So break-even point in sales. So break-even in units was fixed cost over contribution per unit. Break-even point in sales is fixed cost over CS ratio, right? Contribution per sales. And explain whether the hotel should adopt the project. Okay, so we need to calculate the break-even point in sales value of project 1 and then explain if the hotel should adopt the project. Just project 1. So we don't need to bother with project 2. So this is what we're concerned with. Okay. For Q1, only the Alka Hotel Management would offer guests a theater package. Okay, couples who pay for 2 consecutive nights. So we need to keep that in mind. Not 1 night, 2 nights. At a special rate of $67.5 per room night. So that's per room night. Okay, so we'll have to multiply this by 2 to get approximately $135. Will also receive a pair of theater tickets for a payment of $100. Okay, the theater tickets are of very good value and the result of a long negotiation. Yeah, okay. The theater tickets cost Alka Hotel $95 per pair. Okay, so they're technically only making a contribution of $5 on the tickets themselves. Alka's fixed cost specific to this project, so they're relevant because they're specific fixed costs, are budgeted at $20,000. The hotel management believes that the theater package will have no effect on their usual Q1 customers, who are all business travelers and have no interest in theater tickets, but will still require their usual rooms. Okay, so what that means is, so we need to assess how many what's the break even for these theater guys, and see if we have enough rooms left to accommodate this based on that. Okay, so let's start with, it's going to be break even for which we in terms of revenue, for which we need the fixed cost over the CS ratio. So the main is going to be the CS ratio. So what's going on here? For each 2 consecutive nights, so let's consider 1 unit to be 2 nights. So the following, let's just make that clear for the marker, right? Calculation is taking 2 nights as a single unit. Okay, we're just making that clear so that there's no confusion. So there'll be revenue from rooms, which is going to be 67.5 into 2. Okay, but we need to remember this when we do analysis later on, that technically this is 2 nights combined into 1 unit. Okay, and then there'll be the revenue from the theater tickets, which is going to be 100. Okay, so the total revenue is going to be $235 for this one unit of 2 nights. And what is the variable cost going to be? There's no specific, alright, there's a theater cost as well. So variable cost for rooms, which would be the same $60 that we had above, and there's 2 nights, so we need to multiply it by 2, so minus 60 into 2, and then there's the variable cost for tickets, which is going to be $95 as we saw in the case scenario. Okay, so we're left with our contribution, which is going to be $20. That's pretty low. Okay, so our CS ratio is going to be 20 contribution over sales revenue 235, 0.085 something, right? So we'll just put this as a percentage. Okay, 8.51%. And our fixed cost for this project was $20,000. So our break even in terms of sales revenue is going to be this 20,000 divided by the 8.51%, 235,000 in revenue. Okay, 235,000 in revenue, but that's not in terms of rooms, and we need to look at how many rooms this is. Well, we can find that easily. So break even in terms of rooms is going to be, you have this 235,000 divided by this much. This will tell you how many units we need. So this is break even units, and remember each unit has 2 rooms like we mentioned above. Let's make that bold so that we also keep referring back to it. So break even number of rooms is going to be technically this into 2. So we need 2,000 rooms. How many do we have available? Well, this is for quarter 1. 900 rooms were occupied. So it's not the 6,000, sorry. It's going to be the 900 occupied rooms. And in 1 quarter, we'll have 3 months. So we can find the quarter. Rooms available during Q1 are equal to, so it's going to be 1 quarter, 900 rooms are going to be available. So 25 into 365 divided by 4 is the rooms available in quarter 1. Okay, 2,281 less 900 already occupied rooms, so minus 900 is remaining rooms of 1,381.25. and no, so we don't have enough because we need 2,000 rooms. But notice the numbers, right? If we had mistakenly assumed it was 1,000 rooms, forgetting to multiply it by 2, then we would have said, oh yeah, if there's enough rooms, they should go for the project. The fact that we remember to multiply by 2 means, oh no, there aren't enough rooms, and furthermore, we remember to take out the 900. If we had not taken out the 900, then this value would mean that there were still enough rooms, right? So there's a lot of tricks that the examiner put here for you to potentially lose marks. So remember, we need to be careful. Okay, so we can say, given that there are not enough rooms available, let's mention this, is less than the 2,000 needed, right? Project 1, there are not enough rooms available to break even. Project 1 does not seem feasible. Okay, anything else they need for part C, or are we done? So calculate the break-even and explain whether the hotel should adopt the project. No, we've explained it, they shouldn't adopt the project. So let's just make that explicit using the terminology they've mentioned, right? So the hotel should not adopt project 1, right? So we're being blatant about it, that yes, we're answering your requirement using the very same words that they did. Okay. Part D for 8 marks. So this is the main part now. Using the graph, quantify and comment upon the financial effect of project 2. So now we're looking at project 2. Note there are up to 4 marks available for calculations. So calculations using the CVP graph. So we need to analyze the graph. Remember what I said? The computer-based exam, you're no longer required to draw the CVP graphs, but you are expected to know how to analyze them. And 8 marks means we have to analyze this quite extensively. Okay. So project 2 about a restaurant. There is scope to extend Alka Hotel and create enough space to operate a restaurant for the benefit of its guests. The annual cost, revenues and volumes for the combined restaurant and hotel. So not only is the chart for the restaurant, but for the hotel as well. So we can compare it to our original data in our calculations above, as in without restaurant, and the graph as in with the restaurant. Okay. Note the graph does not include the effect of the theater package. Of course, it's a separate project. Okay. So 8 marks worth of analysis. Let's just recap on the requirement. It says using the graph, quantify, meaning show numbers, and comment upon the financial effect, and 4 marks for calculations. Okay. So let's break down the graph. You have your margin of safety, you have your fixed cost, variable cost, sales, all of these different things we can analyze. You have your break-even point over here, remember, the 5,161. So let's analyze all those things one by one. Okay, let's start with, let's give some headings so that the analysis looks proper, right? So let's start with sales, okay? And we'll make the heading distinct as always. So sales revenue. Is this for a quarter or no? It's the annual, right? The annual cost revenue. Okay. Sales revenue is now annually $2 million, right? $2 million with the restaurant. Okay. What was it previously? Did we calculate that? Annual revenue, that's quarterly revenue. So if this was quarterly revenue, what was it previously? Because that's tricky, because quarter 1 they've said 900 rooms. We'll have to do an extensive calculation there. Or we could just go by the revenue per room, right? Let's make it simpler for ourselves. So how many rooms do they have in total? Number of occupied rooms they mentioned is 8,000. So if 8,000 rooms are occupied, technically they wouldn't occupy 8,000 rooms, because look at the margin of safety. It ends at 7,300. So they're assuming only 7,300 rooms would be occupied. But since the sales line is constant, that means the price is constant per room. Let's find the price per room, because we have that information above, right? The price per room was given at 180, right? So we can compare it to that. Okay. So this translates into revenue per room of, so 2 million, 123 divided by 8,000, $250. This is more than the revenue without the restaurant of $180. Okay, thus the restaurant is contributing a $70 increase per room. Okay, so we have some calculation and we have some analysis down. Okay, let's move on to the variable cost. So remember, this is a traditional break-even graph. Why? Because there's no variable cost line. Instead, there's just the total cost. But the variable cost can be simply found by taking the difference between the fixed and the total cost. So the total cost for 8,000 is 1,560,000 and fixed cost is 800,000. So the total variable cost if 8,000 rooms are occupied is, and then we can simply take the 156 800,000, and since we're gleaning this from the graph, let's make it clear. This is the difference between the total cost, because remember the question is asking us to analyze the graph, so we need to clearly show how we got this from the graph. Total cost line and the fixed cost line. Okay, we can also find the variable cost per room and compare that to the $60 variable cost we had originally, right? This translates into a variable cost per room of how much? 760,000 over 8,000 is going to be $95. This is higher than the $60 variable cost without the restaurant. So effectively that means that each restaurant, and we'll fix the spelling here, thus the restaurant is contributing a $35 increase in variable cost per room. Okay, so the contribution is effectively $35 per room from the restaurant. Okay, then we have our fixed cost. So the fixed cost we've already seen is 800,000. The fixed cost is now 800,000. How much was it originally? I think we used that in the calculation. Yeah, so we actually did. Annual fixed cost was 600,000. This is a 200,000 increase. This is a 200,000 increase from the previous level of 600,000. Thus the restaurant has increased the fixed costs by 200,000. Okay, so we've gleaned that information. Technically we could also do the break-even calculation for it, 200,000 over the contribution per unit of 70 minus 35, but would we have to? Let's see, we might put that in later. Okay, margin break-even, there's still the break-even of 5161. So they have the break-even collectively for the restaurant and the hotel. Let's consider that, right? Restaurant in isolation, it doesn't make sense to actually look at the break-even number of units because we're always going to be running the hotel. And then we have the margin of safety as well. Okay, so break-even combined with the restaurant, the hotel has a break-even at 5161 rooms. This is, it is higher, I believe. The old break-even was 5,000 room nights, right? So slightly higher than the old break-even of 5,000 rooms. Okay, so the break-even has actually gone up, which is interesting because the revenue brought in more revenue, but because of the increase in fixed costs, the overall break-even slightly went up. Is that good or is that bad? Let's analyze that at the end when we get all the information down. Okay, margin of safety. So what happened to the margin of safety? We calculated the margin of safety percentage up above, and it was 21.72%. Let's compare this to that, right? We already have the numbers. The margin of safety percentage is now, so 7,300, the budgeted number of rooms, and 5161 over 7,300, right? So it's 29, so that's increased as well, which is a good thing. Margin of safety, the higher the better. So this is actually increased. Oh, and we also use the budgeted units of 7,300. Let's mention that because that's gleaned from the graph as well. The graph shows that the budgeted number of rooms, budgeted number of rooms, technically we can look at the occupancy, right? There was an occupancy rate of 70%. Let's see how much, because 7,300 out of 8,000 means the occupancy seems to be more than 70%. We'll shift this line elsewhere, right? So the graph shows the budgeted rooms is now 7,300 annually. Okay, let's make that here. We're gonna do the calculation for occupancy rate. So we'll take this little birdie up here. Okay, this is an occupancy rate of how much? This is an occupancy rate of, so we have 7,300 rooms out of how many total possible rooms? Let's go back to the information on the top. We have 25 double rooms and 365 days a year. So over 25 over 365. So the occupancy is 0.8 or 80% now, which is more than the previous occupancy rate of 70%. So that means the restaurant is increasing our occupancy. This is higher than the previous occupancy of 70%. Okay, this means the restaurant has brought in more customers, increasing the occupancy by 10% overall. And for hotels, occupancy is a key metric, right? They're always focused on that because you bring customers in, that's where you get money from them. So they've done that. They've increased the revenue per customer by $70 and the number of customers as well. So overall, it looks like a very good picture actually, just based on this data. The occupancy changes everything, right? And the margin of safety is now 29.3%. This is higher than the original margin of safety of 21.72%. Okay, so I think we've covered pretty much every single number we needed to in the graph. So we've done the analysis part, quantifying part. Comment upon the financial effect. We've also sort of mentioned that. Okay, there's 4 marks for calculations. Let's just write a bit more. Let's write a conclusion so that we bring it all together and have some discussion there explicitly, right? Conclusion. The restaurant has increased, that's the main point, occupancy by 10% to 80% in total. This is great for the hotel, as more customers means more potential to make money. Okay, furthermore, the revenue per customer per room has increased by $70 and the contribution per room has increased by $35 because the variable cost per room was $35. We'll show that in the brackets, 35, so $70 minus $35, so that the marker knows where we got this number from. Even though the fixed costs have increased by 200,000 and the break-even has slightly increased to 5161 rooms, the overall margin of safety has improved to 29.3%. Okay, do we need to give a conclusion using the graph comment upon the comment? So yeah, let's just give a comment. Overall, it seems to have, the restaurant seems to have a positive impact, and let's conclude with the key point on why we're saying it's a positive impact. Because it increases the occupancy, which is the number of customers, and the contribution per customer. Okay, so we're done. 8 marks worth of analysis. We're done with the calculation and the analysis. Okay, so let's just analyze a few takeaways from what the analysis that we did. So we broke it down into steps. First of all, we gave headings. For the CVP analysis, there's always going to be certain themes you're going to explore. Always explore the lines in the graph. So the revenue line, the total cost, we split into variable and fixed costs and analyze them separately, because total cost as a whole, analyzing it doesn't make too much sense, honestly. Though we could say sales minus, oh, that's another point actually, sales minus total cost, the profit, but we couldn't find that on 7,300. We can find it for 8,000 units. You could mention that as a throwaway point. We don't have to, because honestly we have more than enough points. Okay, fixed cost, margin of safety, break even, we covered all the points. Now a question some of you might have is, do we need to analyze in this much detail and cover all of these things? The answer is yes and no. So technically it's an 8-mark part, right? To pass you need 4 marks. Obviously you want to get more than that. You want to get as many marks as possible, but don't worry too much about being in exactly this amount of detail. Okay, ideally, because the graph included all this information, the examiner might have an expectation that you go through all of this. Okay, but for example, the occupancy rate, maybe you didn't do that, right? Margin of safety straightforward, break even straightforward, and the graphs are straightforward. So all of that would be par expectation, right? You should have done those, but the occupancy rate, you could say, is an extra step that you would definitely get brownie points for, extra marks for, but it's not critical. Even if you just did margin of safety, break even, fixed cost, variable cost, sales, right? That's a good, and the conclusion, that's a good 6 marks, 5-6 marks at least for your answer. Okay, so don't worry too much about that. Okay, that's the analysis. The calculations were mostly simple. Part C, we needed to just look at the tricks of 2 nights and a single room. Remember, when you're looking at quarterly figures and annual figures, as they were trying to use tricky numbers there. But apart from that, yeah, it's relatively straightforward. Okay, so I hope you guys benefited from this question, and I'll see you guys next time.